I want to review the key events of last week and set the scene for markets over the coming days. Clearly, we've seen significant developments in European politics, but also in terms of the oil price. But I also want to spend a minute looking at our positive view on UK commercial property. The start of the month sees a plethora of economic statistics, including the US payrolls, but I want to focus on the purchasing managers' indices. I think that they're not only timely, but a very good assessment of the state of the global economy and come out from each individual country. Rather than just opinion polls on business confidence, they reflect questions about actual activity, how much has a company's orders, production, vacancies, prices gone up or down compared to the last month. With the US manufacturing sector seeing the PMI rise to 53.2, that shows that the economic recovery remains on course. Those political developments that we've seen, some have had real impact. So the agreement by OPEC to limit production has pushed up the oil price by 10%. However, it's a political agreement. Obviously, agreements between Saudi and Iran are about diplomacy rather than simple business. And we think that the economic realities means that there's a limit to how much further they can push up the oil price in the face of weak demand and the scope for US shale oil supplies to rebound. Elsewhere, the elections over the weekend, or rather the voting over the weekend in Europe, has more limited impact, though doubtless will cause volatility, because there are few executive powers for the Austrian president, while the Italian referendum was about constitutional and political issues rather than the economic reforms that that country clearly needs. One of the sectors that we invest in that has been most affected by politics this year was the UK commercial property sector. It was down 15% on the day after the referendum. It's now recovered, down 5%. We still think that having reassessed it, it is an attractive area for investment with 5.5% yields. The UK economy remains robust, and while this has been most vulnerable to worries about Brexit, it is also an asset that could perform if those worries lift or if we see sterling appreciation. We remain long-term investors in UK commercial property and the UK economy.